Yeah, hello everybody. Here we are again with general introduction to tax law from our boring channel, and this is now a chapter somewhere in the middle. This is chapter 7, double taxation treaties, a very short introduction so that you know some basics already which you need in the future. So basic things today also. So a lecture for beginners, as I think you most probably are. Good. Now, double taxation treaties, the first interesting thing is there is never ever a very clear denomination for that. Sometimes they are called double taxation treaties, DTT, sometimes double taxation conventions, then some people abbreviate with DTC, or double taxation agreements, DTA, so get used to all of them. If you then speak with a German tax advisor, for example, you can forget all about all of these abbreviations because the Germans call it Doppelbesteuerungsabkommen, abbreviated with DBA, DBA. Well, so chaos already at the beginning. Here you see that it's not a very easy lecture, but yes, it is naturally. That's probably the most complicated thing here, that everybody uses different words. Well, let's go a bit into the matter. International treaties, that is what double taxation treaties are, and they just talk about when your world income is from several states and they want to avoid that you are taxed in both states. Here, for example, due to unlimited tax liability, and there where the money comes from due to limited tax liability, that might be in the total too much. And so they might make treaties which then regulate how the prey is divided, so how the taxable income is attributed to the different states which are interested in your taxation. That's the most interesting part. Double taxation treaties just divide the income which a taxpayer has between the states involved. Mostly they are bilateral, so only two states enter into negotiations and conclude a double taxation treaty. So naturally, as there are approximately 200 different states and territories with tax laws all over the world, um, you have a vast number of double taxation treaties outside there, and only in a very few cases you have double taxation treaties where more than two states agreed on a common set of rules. For example, there is a multilateral DTT between the Nordic states, but this is very rare. Good. How do DTTs work? I hope from one of the former lectures in this class of lectures here, in this general introduction, I hope you remember a very basic fact in legal things. There is always general rules and special rules. And the special rules are designed as the exceptions from the general rule, so they win over the general rule. Where there is an exception, you follow the exception and apply it. So special rule prevails. And now double taxation treaties are nothing else than special rules deviating from the general rules in the national law as far as they say something on the case. For example, you should imagine the Income Tax Act, the ESDG, the Einkommensteuergesetz of Germany, says what happens with regard to all your income from the world, everything taxable. Now, a double taxation treaty says what happens with regard especially to your income from France. France is now an arbitrary example. You see that as always when in my slides there is a little asterisk before a number or a name. This is just arbitrarily chosen. The explanation is I just need a name, a country, an example. So here then you have a conflict. ESDG says what happens to income in general. DTT says what happens to income from France. And so that's the more special law. And in cases of conflict, it prevails as far as the conflict goes. This is rather common sense. Nevertheless, common sense, it's always good if you have a confirmation somewhere in written form also for common sense, or even for common sense, because one never knows what a lawyer could do. And so the German General Tax Code, the Abgabenordnung AO, confirms explicitly even and already in its second paragraph that double taxation treaties and other potential treaties with other countries referring to taxation prevail over the usual standard national legislation in case of a conflict between the two rules. That does not mean, ladies and gentlemen, that now the DTT rules have a higher rank, or they couldn't be changed, or you couldn't deviate from them. They don't have a rank like a constitution, so they are not unchangeable for a parliament. According to the mainstream view, at least in Germany, the situation is as follows. A state signs a treaty with another state that is now bound by the treaty, but that is only an obligation towards the other state. So nobody else than the other state could complain. And inside your own state, the prevalence of the double taxation treaty rules just and only relies on the fact that Parliament said this has to be regarded as an exception from the general rules. So the consent of Parliament to the treaty is nothing else than a simple standard law like every other law in the world. And so Parliament could, that is the prevailing theory in Germany, or the dominant one to express it more clearly, the opinion of the majority, that Parliament could now even say, oh, we make a new rule, a new law, which we design and mean as an exception to the exception. So tax the worldwide income according to the rules in the ESDG. Exception, if it's something from France, follow the rules in the DTT France. Exception from the exception. If now there is a very special case, which we now describe in that more special rule, then please follow our very special order, the exception from the exception. Legally, that's possible. Then you deviate from what you promised to the other state. That could bring the other state to protest against that, but very often they don't do. And, well, they are, in the final effect, also powerless. They could try to take something like revenge on you by standing down from some own obligations just to give you some pressure. But if you don't want to start a war over something like that, and you usually don't want to, then such a deviation can work in real life without problems. So never rely on that rule in the double taxation treaty, which you think, I can be very, very clever with that and design extremely favorable tax saving models that you can rely on that till the end of eternity, because treaties are promises and promises can be broken. You see here how that could be done. Well, let's concentrate again on the simple situation. So how would that work, the functioning of DTT rules? Imagine you have a German person residing at Kleve. Then you know already, if it's a German person, so person would be natural person, so the Income Tax Act, the ESTG applies, and Kleve is in the German inland, so having a residence living at Kleve leads to unlimited tax liability under paragraph 1, section 1 ESTG. So we have somebody who has, according to the usual rules, to pay tax on the worldwide income according to paragraph 2, section 1 ESTG. Now, the double taxation treaty with France probably says income from a business which you run in France, for which you have a so-called permanent establishment in France, is only taxed in France, and so it's tax-free in Germany. It is, as one called it, exempted in Germany. Now the consequence is the general rules says tax everything which that person has. Now DTT says don't tax the stuff from France. So the final result would be everything is taxed apart from the income from France. Now the tax rate, how would that be determined? Well, the DTT doesn't say anything about the tax rate which Germany levies on your worldwide income. It only says leave the income from France tax-free. So how high or low we set the tax rate for the rest is entirely our own affair. We can freely decide which tax rate we apply, on which reasons we apply that tax rate. So we can freely decide to determine the tax rate according to an auxiliary calculation which takes into account the whole existing world income of that person, because promising we don't tax the income from France does not mean, DTT doesn't say that, so it's not a rule. It doesn't say that you have to ignore the French income completely. For other purposes than taxation of the French income, you can take it into account. Okay. So you can already conclude from that wherever and as far as a double taxation treaty does not say something, the rules of the Einkommensteuergesetz, or naturally in case of a GmbH of the KSTG, still apply, or in case of what you later will learn, the city tax in Germany, the so-called trade tax or Gewerbesteuer, the same applies. Wherever the DTT remains silent, the usual rules apply. That leads sometimes to strange effects. For example, it might be that the double taxation treaty says, in your specific situation, nearly all of your worldwide income goes to France and Germany is only left back with a very, very small rest of your worldwide income, which we can tax. Now you would still be taxed according to the rules of unlimited tax liability if you have a residence, one is sufficient, or the habitual abode, you can only have one, in Germany. Because German law says, when I apply, the first step is which rules are applied. Unlimited tax liability, if somebody lives here, or limited tax liability if that person does not have a residence in Germany. And this classification is not overrun by the double taxation treaty rules. They only say leave a part of the income tax-free. Nothing else. Nothing, no command to change the rules, how ESTG sees you, and so. Even if in the double taxation treaty, if somebody has two houses, one in Germany and one in France, and now the double taxation treaty says, for reading the double taxation treaty, do as if that person only lived in France, were resident for the double taxation treaties rules in France. Then that does not turn you into a limited tax liability taxpayer in Germany, because the double taxation treaty clause on residence is explicitly limited to the application of the Double Taxation Treaty. So when you read, let's say, Article 4 on residence, and you have to do this because many of the rules of the Double Taxation Treaty will require that you can decide where the taxpayer is mostly resident. Then the DTT says we do as if that taxpayer, let's say, were only resident in France, but the decisive words are then for the application of the Double Taxation Treaty rules. So let's say that after reading the Double Taxation Treaty, you get a clear result. France gets the interest, the license fees, the business income from France, all the income from third countries, and Germany only gets the rent from a house at Düsseldorf and the income from a small business somewhere at Munich. So vast amounts of money tax-free. Germany only a very, very small remaining slice of the income. Then you have got your result from the Double Taxation Treaty. You know which state can tax what. And then you look into the Einkommensteuergesetz again and say, now we are going to tax that what we can tax under our law. And then you ask the taxpayer, well, are you unlimited tax liability taxpayer? No, taxpayer says, the Double Taxation Treaty says, I'm resident in France. Then your tax officer says, that's a different movie. The ESTG says the rules for unlimited tax liability apply if you have a residence in Germany. Do you have? And the answer is yes, I have somewhere a small flat, which I rarely use in Düsseldorf. Okay, congratulations, unlimited tax liability rules apply. So then let's go on. You have to pay taxes on the worldwide income apart from blah, 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 nearly everything you have. Left over are rent from a house at Düsseldorf and the income from a very, very small business at Munich. Okay, let's say this is 30,000. Oh, now let's look for the tax rate with an unlimited tax liability taxpayer. We have to compute the tax rate according to that person's worldwide income. Well, I hear from my colleagues in France, your total worldwide income is 5 million. So we end up with a rather high tax rate. Now, taxpayer says, well, but I have heard that under the rules of unlimited tax liability, I can deduct special expenses and extraordinary expenses. And here they are, 20,000. So from my income is only 10,000 left. 30,000 minus the special expenses and so. Okay. And let's redo the whole calculation. You are taxed on the grounds of 10,000 based on a worldwide income of 5 million minus 10,000. Special expenses. Still leads to a rather high rate, but congratulations. Here the rules of unlimited tax liability really did you something good. So whenever later we speak in this chapter about being resident somewhere, the important sentence in that article in the Double Taxation Treaties is usually the limitation expressed by you are considered as resident for the application of these treaty rules only. And when we got our result, which state can tax which income, we close the Double Taxation Treaty. We forget all about the way which we got there, especially if we forget about all these resident stuff which we debated there. And so we completely forget the Double Taxation Treaty residence decision, and then we treat you normally under national law with that which remains to be taxed under the treaty rules for us. Okay, good. So, yeah, when it comes to a real case, so you always have a first step. You analyze the Double Taxation Treaty and find out which states involved can, or better, may tax which parts of the income. And the second step is then you apply to that income which that state may tax the national rules of that state according to the testing schemes which you learned there. And so, well, okay, now let's turn to the contents of a double taxation treaty. What can a double taxation treaty say, and what is impossible there for practical reasons? Now, a double taxation treaty, this is here the headline, is just an agreement between states, and that means it's made in a relatively complicated way. Government officials meet and have a great blah blah, discuss, make a draft for a text, then tear apart the draft, redraft it, and so on. You have blah blah and so on for a long period of time. Then the experts agree. Then the governments of both states approve the text, say they want to sign it. The text is then turned into a law or presented to the national parliaments with a request to make them into a law and to agree to the contract. Because an international treaty can only have the binding effect as a law if Parliament allows that and turns it into a law. And usually, whenever an international treaty is negotiated, the persons doing the negotiation have the obligation. They are not allowed to sign anything definitively. There is always a so-called ratification clause, so that the negotiation result has to be confirmed by the two states' parliaments. Good. Now Parliament passes laws in two states. Then the heads of states, so the president or the king or queen or so, officially signs the treaty and officially communicates to the other state, my state gives itself the honor to inform you that we have decided to bring that treaty into legal effect, and they exchange the ratification certificates. Then the treaty enters into force at the next possible date. Now, in practice, what does that mean? That takes an eternity, ladies and gentlemen. So you are absolutely not able to react to quick developments or so. For example, in Germany and Belgium treaty at the beginning of approximately the year 2000, one wanted to change one little article, or even less, one small paragraph in one article. So the text of the change was negotiated between the employees of the two ministries. Then it was agreed by the competent ministries, so by the government members. Then it was presented in Germany to the German Parliament Bundestag, and I probably believe to the Bundesrat too. There, I'm not sure in that legal details. Also, it had to be presented to the Belgian Legislative Corporation. That was the Parliament of Belgium, the Parliament of Flanders, the Parliament of Wallonia, the Parliament of Brussels, the representation of the German-speaking population in Belgium, the representation of the Flemish-speaking population of Belgium, and the representative body of the French-speaking population of Belgium. Then it was signed by the King of Belgium and entered into force only 4 years later, or even more, in 2004. So that should illustrate that it's absolutely impossible to be flexible with the rules. The rules which you write into a double taxation treaty are probably not for eternity, but for 20 years, 30 years, 40 years, they will remain nearly completely unchangeable. That means, on the other hand, logically, you can, under no circumstances, write into a double taxation treaty any detail which might have to be changed quickly. So, no rules about the tax rates. because you might feel the need to increase them or you might want to lower them. And that's not possible if, for example, you lay down in the treaty Germany-USA that the corporation tax rate in Germany for the American firm would be 15%. If you would like to increase it to 20, you would have to renegotiate that article of the treaty. Or if you would like to lower it, you would also have to renegotiate it, and that would take years. And as you now have, let's say, 80 or 90, at the moment Germany has approximately 90 double taxation treaties. Now that would be years and years and years. And probably when you have finished the change in the last double taxation treaty, you have already decided for the next two changes of your tax rate. So it would be a complete chaos. The same applies to the deductibility of business expenses. Rules like the American is taxed with the German profit from a German firm which he owns or she owns in Germany, and hospitality expense is only deductible with 70%. Such a rule is impossible for a treaty because you might feel the need to change the 70% to 60%. And that would be absolutely impossible, again, without rewriting 90 different treaty texts. So, simply impossible. No details ever possible into a double taxation treaty. The evident solution is a double taxation treaty can only say which state may demand taxes on which part of the worldwide income and which state may not. So, for the worldwide income of the taxpayer, the double taxation treaty only says the license fees can be taxed by France. The dividends can be taxed by Germany and England jointly. The house in Munich can only be taxed by Germany, and so on. So all the details how something is then taxed are only laid down in the general rules of the national usual law of that specific state. So when the DTT says the rent from a house in Munich can be taxed in Munich, full stop, that's the whole thing which is then said. And now if our taxpayer is an American, the German tax officer would then just say, okay, double taxation treaty says I can tax you with your rent from Munich. Now let's look if my law really says we do this, and let's find out the rules. You are American, so you don't live in Germany? No. You never stay here for a long time? No. You don't have a secondary residence here? No. So then you are limited tax liability taxpayer. Okay, section or paragraph 1(4) ESDG says limited tax liability. Now let's look to section 49 of the ESDG and look up if the rent from a house in Munich can really be taxed here, even if you are a limited tax liability taxpayer. I see paragraph 49. I believe section 1, number, let me guess, 6, says rent from a house in Munich is taxable here, also for the limited ones. Okay, so we tax you. Now let's find out in the text of the ESDG the tax base, compute it, and let's find out your personal tax rate under the rules of limited tax liability. Okay, so all the details are only laid down in the domestic law of a state. And the advantage is there. Now, if you want to change, let's say, the corporation tax rate from 15 to 20%, you don't need to change all the double taxation treaties. Because you just change, let's say, on the 31st of December, the legal text of the German law, replace the 15 by a 20, and now from the beginning of the next year, all the treaties which say the income can be taxed in Germany directly refer to the new text without that they needed to be changed. All these DTT says German law applies, and German law now says 20% for everybody without any exception. So that's then flexible enough. That's the reason for that mechanism. Good. Here again, such an example. Imagine you have somebody living in the Netherlands, Dutch citizen, has a shop in Germany. Double taxation treaty says Germany may tax the shop, but may not tax the rest of the worldwide income. Now, Germany only gets the result you can tax the income from the shop, and how and if we really want to tax that, that has to be determined in the German law. So you would now open the Income Tax Act, the ESDG, look into it, find out the Dutch person is limited tax liability. If there is not even a secondary residence in Germany, then you look through the paragraph 49. If there is a German tax claim on that, a shop is a so-called permanent establishment that's mentioned in paragraph 49, 1, number 2, I believe it's letter A. Please look it up to get safe and certain there. And then you find out, oh yes, it's taxable. And then you have to go into details how the profit has to be calculated according to the rules of the ESCG and which tax rate applies and so on. And you are at home in your well-known legal rules. It may even occur that a double taxation treaty says a certain state can levy a tax, but then the national law of that state says, no, we don't. We are not motivated. We don't want to. You know that perhaps already. You know private property under German law is basic rule, tax-free when it is sold. It has been hollowed out strongly, that principle, so it has been covered covered by many exceptions. One of the exceptions is, for example, in case that you sell real estate, private property, a house, a building, that will be taxed if you sell it within the first 10 years after acquisition. But as under the present state of affairs, only if you sell within the first 10 years after acquisition. And now imagine the double taxation treaty Germany-France says, if a French person sells a real estate property in Germany, that may only be taxed by Germany. Then we have a clear result. German law applies and only German law. Now, German law, you open it up, look into, and say, okay, how long has that property been owned? Owner says 23 years. German tax officer says, okay, forget it. There is no tax claim here. We could tax, but we don't. That can also happen. Yeah, so keep in mind double taxation treaties. That is the second important conclusion or rule which you need to know. A double taxation treaty never contains details which might have to be changed within short time. So the non-deductibility limit for business presence or so, no, only national law. If you want to adjust that to inflation or abolish that, you don't need to change all the double taxation treaties. That's just a matter of national law. So if national law says we increase that limit for business presence or we turn them into non-deductible expenses in all cases, even if they are lower than 35 euro, that could be easily done by just changing the one and only sentence in the ESDG, because everywhere where a double taxation treaty says Germany can tax business profits, the business profit will be computed and assessed according to the rules of the German national law, and you just changed the one sentence in these rules, and that takes effect for every case when German law applies. Yeah? So very, very clearly understand this. Treaties only say which law can be applied to which part of the income, which state can apply a law. But if a state wants to make use of that right to tax and how it does that, that is only and entirely a matter of the national legislation. You are, as a state, not even bound to make use of your rights under the DTT in a logical way. For example, imagine you have again somebody from France, let's say some dramatic case, a French widow with a residence in Paris and a secondary residence in Bonn in Germany. She gets a dividend of 100,000 euro from Germany, and under the double taxation treaty, the dividend can only be taxed with a maximum of 10% in Germany. In that case, the double taxation treaty could say Germany can, if it wants to, levy a tax of up to 10%. Now, somebody with a secondary residence in Germany would be subjected to unlimited tax liability. Unlimited tax liability has 7 types of income. Type number 5 is income from capital, that's dividends. Under German law, dividends are taxed with 25%. Yes, so here we have a claim of 25%. Now the double taxation treaty comes as a special rule and says, but the maximum is 10. Beyond that, a tax claim is not possible. So everything of the 25%, which exceeds that 10% limit, is cut off and cannot be kept by Germany, because here the special rule is clear. In practice, that would work in a way that the 25% have been paid to the fiscal office as a withholding tax, that you got an attestation about that, a receipt or what else, and that then, as you have a secondary residence in Bonn, you hand in your annual tax declaration as an unlimited tax liability taxpayer, prove that nearly nothing of your worldwide income can be taxed here in Germany, and that the 100,000 tax is limited to 10% of the 100,000, then you get back all the exceeding 15%. If our taxpayer didn't have a secondary residence in Bonn, Germany, nowhere in Germany, then the rules of limited tax liability would apply, and the dividend would be taxed under the rules of limited tax liability, again with a withholding tax of 25%. Now German law would say, good, you don't have German regular tax return to hand in, but you get your money back by way of an application to the so-called Bundeszentralamt für Steuern, the Federal Central Office for Foreign Tax Relations. And nevertheless, that would be the result. Another interesting peculiarity is now how double taxation treaties determine or express themselves. One of the very, very basic things is these are international treaties, and there are certain rules in international law, and the one and only and predominant and paramount and highest rule is that all states always, if they sign a treaty, take the same rights and the same obligations. There is never anything which allows that one state has more rights than another state. The predominant principle of international relations is every state has an equal value, so an equal rank. So it's never allowed that State 1 claims more rights in a treaty than State B. So you cannot agree on such uneven rules like Germany gets the profits from heavy industry and America gets the profit from internet firms. If you want to reach that result, you must establish general rules which treat the both states alike. So an if-then rule which says if blah blah then. So if the taxpayer is from state A and receives income from state B, then this income can be taxed by state B. So that would be like a mathematical formula where you then have to insert state A and state B according to your individual situation. But the important thing is this formula is a general rule which is valid for both states alike. By the way, you could also modify that rule in a way that you say if taxpayer from state A receives income from state B from this and this activity, then the income gets to state A. That's a question of negotiations. But the important thing is the rule is always equally applicable for both states. So you have there these formula, and now you see, like in a mathematics book with formula, they are entirely senseless and meaningless if you do not have a concrete case which you then solve with this formula. But if you have a concrete case, then you just deal with it like with a mathematical task. You try to identify where does the A in my case stand for. So what is state A in my situation? What is the real name for state B? So like variables in a mathematical formula, that is how you treat the stuff. And then you just read, in case of state A, your individual state A, and state B, when you once found out what's state B in your individual concrete case, then you read that name everywhere where you see state B. So best is to explain that with an example. A German has rent income from the US. And now imagine the rule in the double taxation treaty should be if the taxpayer is from state A and receives income from letting a house to tenants in state B, then the income can be taxed by state B. Now this is a bit chaotic, so we must now find out, like in the mathematical formula, what A is in our case. The taxpayer from state A, well, we have a German, so he is from Germany, so evidently state A is Germany. Now we have found that out, and now we know everywhere where state A will be mentioned, we fill in Germany. And receives income from letting a house to tenants in state B. Well, what is state B in our case? State B is USA. So we know state B, USA. Wherever state B is now mentioned, we read instead of state B, USA. Then it works. So you get a very clear and precise sentence. If the taxpayer is from Germany and receives income from letting a house to tenants in the USA, then the income can be taxed by the USA. So our result under the DTT is USA can tax the rent income. They do it. The other way around would also work. An American has a house in Germany. The rule shall again be if a taxpayer is from state A receives income from rent state B, then the income can be taxed by state B, because you know the rule is general and applies to both states in the equal way. Good. Now we fill in again what state A and B are and try to find out. Taxpayer from state A. Well, our taxpayer is now in this case an American. So in this case, A is America. So if a taxpayer from America receives income from letting a house to tenants in State B, that's now Germany, so we know now State B in this case is now Germany, then the income can be taxed by State B. So result, Germany can tax the rent income. That's a clear and easy result. Huh? You have such rules depending on the individual kinds of income in the double taxation treaties. For example number 3. An American receives a license fee from Germany. The rule in the double taxation treaty shall be, if the taxpayer is from State A and receives income license fees from State B, then the income can be taxed by State A. Good. Let's find out. Taxpayer from State A. What's State A in our case? Okay, taxpayer is an American, so A is America. Receives income from State B, well, license fee from Germany, so State B, Germany. Then the income can be taxed by State A. What was State A? America. So America can tax the license fee. Clear and easy result. You just have to identify what's the A, what's the B, and fill it. Oh, good. I hope that basic principle is understood. Remember your times when you were confronted with mathematical formula like A plus B plus 2AB plus blah 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 and so on, and you went mad. And then when you just found out what A stands for and B stands for, then you filled in and surprise, a number came out. So that's here the same. Now there is only one big and really evil obstacle. That is that diplomats write these texts, and diplomats hate mathematics. So when these texts were designed, some diplomats said, A and B, that's not nice. A and B, no, that sounds so. Can't we express these A's and B's in a more literal way? Well, otherwise we should be ashamed when we are compared to Goethe, Shakespeare, Molière, et autres génies. Due to this, they tried to avoid the expression State A and State B and gave other names to the variables which they thought make the thing more nice. So State A was called by them the one contracting state. And State B, they called State B the other contracting state. By the way, that leads then to nice expressions. One could even say when you read so much about contracting states, then you get contractions yourself. But you have just to accept that the one state and the other state are the double taxation treaty terms for State A, State B. They are variables and you just fill in, as we practiced this just a minute ago. Now the only thing is when you read about State A and the one state and blah blah the other state and then the other state can blah 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 blah, that you then should not go mad but just find out what the one state is and the other state. So you fill in again. Imagine the rule is now the rent. If the taxpayer is from one contracting state and receives income from letting a house to tenants in the other contracting state, then the income can be taxed by the other contracting state. Okay, now if you read that unprepared, probably there is a bit of frustration on the way. Now you know this is a formula, and a formula is absolutely senseless if you don't have a concrete case to solve. So we take our concrete case, and this case is now taxpayer from Germany has rent income from Spain. If the taxpayer from one contracting state stop directly, immediately, and find out where is my taxpayer from? Germany. So the one state is Germany, and now wherever the one state is named, we fill in Germany because this is a variable. Letting a house to tenants in the other contracting state. Where is the damned house situated? That would be Spain. Okay. Good. So wherever now we have found out the other state is Spain. So wherever now in our formula the other state shows up, that will be Spain. We fill in Spain. Yeah, then the income can be taxed by the other contracting state. Other state was Spain. So simple translation. If a taxpayer from Germany gets rent income from Spain, then the income goes to Spain. The income can be taxed by Spain. Now, that's a clear, precise, and really easily understandable answer. You must only know the trick. Fill in. License fees. Again, just to practice that, to make you familiar with that. If the taxpayer is from the one contracting state and receives income from license fees from the other contracting state, then the income can be taxed by the first mentioned state. Okay, now somebody really tried to be a literary genius and replaced the one state by that cross-referencing the first mentioned state. Okay, but now again you have in mind variables are here in the field. So we take our concrete example. A German gets a license fee from Mexico. Taxpayer from one state, stop immediately. Where's our taxpayer from? Germany. So the one state is the word for Germany, and every other expression for the one state is Germany. Receives license fees from the other state, Mexico. So if a German receives license fees from Mexico, then the income can be taxed by the first mentioned state. Which state was mentioned first? Germany. Okay. So translation, if a German gets license fee from Mexico, the license fee can be taxed by Germany. Only, by the way, is meant. I hope you got the principle behind it. There have generations of beginners gone mad with that, but now it might be a great consolation for you, a comfort which makes life easier when I tell you that it might be that beginners go mad with this stuff, but also for those who are longer in the field of taxation, that status of madness never ends. So don't be ashamed. Everybody goes mad over that, but once you have understood it, it's relatively easy. If you really want to shock people, try to express yourself in everyday life in ways like these. That makes you respected by the neighborhood. Nobody will break into your house anymore because they all think you are strange and probably dangerous. Good. Now, when you look back a bit to the things which we had immediately before all these, the one state and the other state, here you see that to determine how the formula are applied, you have to know where the taxpayer is from. And now let's turn back to that problem with somebody with two houses also. Imagine you have a rule like every profit of a business person goes to the country where this business person is from. Yeah, now where is that business person from? Has a house in Bonn and a house in Paris. Now, is it from it? No, business owner is not an it. Is he or she or a child might be it. So if a child as a business owner, no, forget about it, has a house in Bonn and a house in Paris, would be a bit too big for a child. But so if a business owner, let's say he or she has two houses, one in Bonn and one in Paris. So every state will first think, that's one of us. But now if both states read that rule, then both states claim the complete business profit of that person. So then you have again a double taxation. But that was what you wanted to avoid. You wanted to divide and distribute the income between the two states involved. So you need clear, simply you need clear rules. not everything getting confused by different results if different people read the rules. So the French would read, I get everything. The German would read, I get everything. That would be chaos. So when it comes to reading the rules in the DTT, you have first to find out which country has the role of taxpayers' residence country. So you must determine that first. Before you do not know where the taxpayer is from, you cannot apply the text. And then you can read and find out where the income comes from. So that is one of the first articles already, Article 4 in the so-called OECD Model Convention, that defines where you are resident. But as I already told you, that is only a decision which is valid for the purpose of reading the Double Taxation Treaty. That does not change your unlimited tax liability if you have a secondary residence in Germany. No, it is only a help for reading the DTT rules. Imagine a Chinese student lives in Kleve for the duration of his or her studies. Family, private relations, and so on. Main home are still in China. And so under the Double Taxation Treaty, in Article 4, I believe, paragraph 2, letter A, it's decided that under such circumstances, a taxpayer is regarded as resident in China. So for the application of the treaty rules, that taxpayer would be Chinese. When it later comes to how Germany taxes the income which is left over to be taxed by us under the DTT rules, then Germany would open the Income Tax Act and look to the Chinese student. Do you live at Kleve? Then you have a residence here. So you are classified as unlimited tax liability taxpayer. So everything which we still can tax under the Double Taxation Treaty will be taxed by us under the rules of unlimited tax liability. By the way, very favorable for the Chinese taxpayer student, because if that student has a taxable income, he or she could not only claim the basic allowance, which is reserved for unlimited tax liability payers, but also could claim special expenses, for example, study costs up to a certain limit, and extraordinary expenses, although these are rare, which is why they are called extraordinary expenses. Now, let's turn more to the contents of the double taxation treaties. There is a need for standardization because, they are bilateral. And Germany alone has approximately 90 double taxation treaties. And while Germany is not alone in the world, so all the other states also conclude bilateral double taxation treaties. So the number quickly explodes into thousands. More than 3,000 or more than 10,000. Nobody did ever count them. Or perhaps people did and ended up in a home for the mentally ill. One never knows. Perhaps there is even a database which has them all. I don't know. Now imagine you learned how to understand the double taxation treaty Germany-France. It took you 2 years, 3 years, 4 years to be an expert there, and then boss says, how would that be treated in France? You say, okay, no. And then boss says, for comparison, how would it be treated if we invested in Italy instead? Oh, I don't know. I only understand the French treaty. The Italian treaty is different. Would have to go to university again and study some 2 years treaty text with Italy. That is absolutely impractical. So you need similar text. You need a way to understand that mass of taxes relatively easily. So that need has already been seen in the 1960s and 1970s. So people asked an organization in Paris, the OECD, Organization for Economic Cooperation and Development, originally founded, I believe, 1960 or so in Paris, um, to design a master draft, a model convention, a model text which could serve as a basis for all future double taxation texts. And that happened 1963 for the first time and was improved greatly in 1977. And the trick is the experts working at the OECD Committee for Taxation for that question come from the ministries of the fiscal ministries of 35 industrialized states. The most important states take part worldwide, and they usually try to have informal contact with also representatives of other states. So when they make their draft text proposal, they have made sure in advance that the expressions laid down in that draft could usually be used and accepted by most states of the earth. So when states, so nearly everyone negotiated long time about every detail of that master or draft text of the OECD. And so when the ministries then negotiate a new double taxation treaty text, they usually take the OECD model text as a first starting draft and only modify the things which they think in our bilateral relationship, this aspect must be modified, or there must be an additional paragraph for a problem which the OECD didn't see or so. So everything is strictly copied from the OECD Model Convention, where no modification is strictly needed. So that leads to the effect that 90%, 95%, or even 99% of all double taxation treaty texts are identical. So if you once are familiar with the OECD Model Convention text, you can understand all the other existing treaties usually. The language is the same, the structure, the system, how the rules work, and so on. And that gives you a common basis, which makes it possible to you, if you are familiar with that OECD Model Convention text, to understand most texts worldwide. By the way, naturally, as the world changes, the OECD Model Convention is updated from time to time. For example, I frequently work with students with the Model Convention of 2010. There is a more recent one, for example, one from 2017, but most existing DTTs of Germany still follow the 2010 or even an older version, and that is why naturally when some part of the OECD Model Convention is updated, that does not change the already existing treaties. Only new treaties will then follow the new OECD proposal, so that in the course of time more and more newly made treaties or updated treaties follow the OECD text, because the OECD text is only a recommendation of independent experts officially, not a law, so it has no ability, no force to change existing legal text between states. The only thing which is general consensus is that when a new treaty is made, when an old treaty is updated, one usually takes over the recent updates of the recent changes in the OECD text to be up to date again. You only leave out things from the OECD text for which there is really good reason in the bilateral relationship to ignore them. So the idea is, due to the mass of treaties, you need a standardized text structure and text contents to get along with all the mass of text. And that is why the OECD Model Convention gets its role from, why it's so important. And that is why people, at least at the beginning of the education, usually are only made familiar with the OECD model text, and later one goes into details with existing real conventions. So knowing the OECD model is the key to understanding nearly all of the existing double taxation treaty texts. Yeah, for example, here you have something concerning residence. That first rule, which I mentioned, you must know where the taxpayer is resident for the purpose of the double taxation treaty. And the basic rule is you are resident where you are subjected to a form of unlimited tax liability. They avoid that term and describe it in a general way because naturally other countries don't call it unlimited tax liability but have different names. Now, if you are regarded as resident in two states under the first rule, then you have no clear result, so the test must go on. Then it is decisive where you have your permanent home. By the way, that means the home must be permanent and not that you must be permanently at that home. So even a holiday home which permanently is available for you might be a permanent home, a second one. Now, if you have two permanent homes, that does not really help. Then they ask for your habitual abode. Now, it might be that your habitual abode is neither in Germany nor in France, but in Mexico, or that your habitual abode is characterized by confusion because you are always 2 or 3 days a week in the one country and 3 days in the other country. So that's the whole confusion. There is no clear habitual abode, which one could determine. Then they say, okay, then we make in the next attempt and ask for nationality, so for citizenship. Now you know there are stateless persons, don't have any nationality, and there are people with double citizenship. And then in the end, the treaty text just gives up and says, okay, we have now tested all reasonable criteria how we could determine where that person is from. If even citizenship gives no solution, we have only one recommendation: sit together and decide where the taxpayer is resident from. By the way, that will not work because you have already exhausted all reasonable approaches. And now you say to two simple tax officers from two countries, okay, the resident country gets 500 million of the taxpayer to tax. That would be the worst possible accident. 500 million go to the resident country. Please sit together and just decide arbitrarily, without any reasonable reason for that, which you could give to others, where taxpayer is resident. Imagine you come into such a situation and you have a superior. And imagine you come home and say, success, we solved the matter. I gave in, the 500 million go to the French. And your boss probably says, and you go to Mongolia as a new ambassador. Well, Mongolia is probably a nice country, but you will only find out when you are there. And if it's really a nice country, you will no longer stay there because then they send you to the Sahara without any water to drink because you gave away 500 million just without any reason. So probably both tax officers will be from both states will be absolutely reluctant to agree on the solution, and that's horrible. In case of juridical person, the most frequent solution is still that the place of management then decides about residence. Yeah. Some other typical rules would be, or better, no. If you once determined the residence, then you can apply the rules which distribute the income between the member states of that treaty. So, residence country or the country where the money was earned, the source country. And now you have a long list of activities. It's not corresponding to the 7 types of income under German law because, well, this is a treaty draft for 100 or 200 countries in the world. Naturally, they don't all have the strange 7 types of income catalog of Germany. They have different ones. And so for the double taxation treaty, one developed a different catalog of things, just a list of events. You would have just to check the headlines until you find something which convinces you and might be worth reading. For example, rent income from real estate, Article 6. Also, agriculture would be covered under real estate income because a farm is real estate. 7, income from business. 8 and 9, some additional rules on special cases in business. 10, dividends. And so on. 11, interest. 12, license fees. So you have a long list. Now the interesting thing is the list only says if the source country can tax the stuff. The OECD says, well, in your country where you are resident, we have said at the beginning they claim your worldwide income. So for this is already clear. This is the basic rule. Resident state gets worldwide income. The only thing is if the source state also is allowed to levy tax under the treaty, then there would be a double taxation and the resident state has then to back down from or reduce the tax claim in order to avoid a double taxation. And there are 2 favorite methods, and only these 2 are applied or proposed by the OECD to the country of residence. Either exempt the foreign income, which the source country can tax, that is called the exemption method, or reduce your own tax claim by the money which has already been paid on that income abroad in the source country. That's the so-called credit method because you credit the payment which has been made to the other country to your own tax claim. Both is stated in Article 23 of the treaty. That's probably just in order to avoid a waste of paper, because imagine Article 6. The state where the house is situated can levy a tax, and if you then would add, and the residence country exempts or credits, that would be awkward and boring. 10. Dividends can be taxed in the state where they come from up to 15 or 5%, and the state of residence then credits, blah blah, and so on. That would be a endless repetition, and so one decided, as these 2 lines are always the same, to outsource them to a separate article at the end, 23. So we come to the following testing scheme for double taxation treaty cases. Personal status of a taxpayer is the first thing. Article 4 in the OECD model, so always at the beginning, because you need it at the beginning. After some introductory definitions of important words, you end up with residence. And this is the first step. Then you analyze the events, and then I told you the articles which are bearing headlines like income from immovable property, business income, dividends, license fee, no, I forgot interest income in between, gains from alienation of property, income from employees, artists and entertainers, blah blah, and so on. The whole list is only deciding if the country where the money was earned, the source country, can levy a tax. The second half of what has to be decided, how does the residence country react? What are the obligations or the rights of the residence country? That is always Article 23. Now, if you look to the Article 23 in the OECD Model Convention, you will see there two variants, 23A and 23B, because there has not been a worldwide consensus of what the recommendable text should be. So the OECD just recommended two different text variants, and the countries involved can select for their treaties which variant of Article 23 they are going to apply. So that was not possible to reach an identical solution with the methods to avoid double taxation. So with the definition what the residence country is allowed or has to do, and so there was one big part of countries which wanted a tax which said nearly everything is only taxed in one state. So if the source country can tax, the residence country has to declare this income tax-free, so-called exemption method. And only the so-called credit method is only applied with dividends and interest. And another big part of member countries of the OECD rejected the exemption method altogether and only wanted to apply the credit method. These were the B countries. So you have an A and a B group. Germany belongs to the A group. They like the exemption method and practice them wherever it is possible. And the B group is, for example, the UK and the US. Yeah, now I told you in the beginning that two states have always agreed on the rights and obligations which are identical. Now the problem is if an A and B state want to conclude a treaty, they are not willing to sign the same variant of the 23 article, and so that might be an obstacle. How could you solve that? There is a very diplomatic solution. The idea is both contracting states, so Germany and the UK, just promise to deal with the rights of the resident state, the avoidance of double taxation, in the best possible way which can be imagined under their system in that concrete case. Now, if both states promise to apply the best imaginable solution in their cultural and tax system that is on a higher level promising the same, and then that in different states there are different cultures and different tax systems, and that so because of this the concrete transposition of that principle in state A and state B will be different, so that the English then apply the credit method and the Germans the exemption method. That is regarded as natural and excusable. It just underlines that the states are independent, sovereign nations, where nobody has to listen to or to at least to obey to what the other wants. And that's the core aspect of international law. They want to underline that they all have equal standing and are independent, and that no state has more rights and can dictate over what the other state could do. And that is then plain and simple the explanation why the Article 23 can contain two parts. In the really existing treaties, the solution would be Article 23, first paragraph, if taxpayer lives in Germany, then the following is promised by Germany if Germany is resident state, and then Germany copies the text of A. Second paragraph, but if the taxpayer is resident in UK, so that UK is responsible for avoidance of double taxation, then UK promises to do that as follows, and then UK copies the B text. So the Actual Articles 23 in the Double Taxation Treaty is then just an individual combination of the A and B variant, and you always must know you have to determine where your taxpayer is, and then you read that paragraph, either the first or the second, which applies to the residence country of your taxpayer. Now, there is only one foolproof idea to find out if the A or B variant will apply to a taxpayer. That is, just look it up in the concrete text in the internet or in the database. Nevertheless, there are some rules. So inexact rules which give a good hint what might probably be expected. For example, the continental European states usually prefer the exemption method. And my thumb rule is that's usually the countries where Napoleon had an influence. And now, why do I mention Napoleon for continental Europe? Well, it is the exemption method, and Napoleon is an ex-emperor of France. So you can combine and connect that exemption and ex-emperor of France. So where Napoleon has been, France, Spain, Luxembourg, Belgium, Netherlands, Germany, and Poland, and so the tendency will be exemption method in the treaties. Whereas the British begin with a B. So the British influenced countries are the B group, which prefer the credit method. That's clear. They were against Napoleon, so they didn't follow his approaches. And, well, you can even say, how did they finance that? Probably they financed that wars against Napoleon on credit, and then they even know it's a credit method, which they like. By the way, historically, that's, I believe, not true, but it might help you memorizing this stuff. How does the exemption method work? Just plain and simple. The residence country says whenever the source country has, under this treaty, the right to levy a tax, we renounce on that right and declare that particular part of the income tax-free in our country. That's in the A variant. The proviso safeguarding progression is nevertheless granted, is possible. The credit method, on the other hand, is a bit more complicated. The tax claim is regularly computed without any exemptions and other stuff in the country of residence, and then from the tax which you owe for a certain income to your country of residence, you can deduct that amount which you have already paid abroad. So you only need to pay the difference still. So that would work in the following way. Imagine you have 100 euro income from capital. Under German law, 25%, so 25 euro are due. Now you already paid abroad 15 euro, so calculation is 25 are owed. 15 can be credited as already paid abroad, so the remaining difference, which I still really have to pay in Germany, is 10 euro. Now, naturally, there are certain limits to the credit methods. Imagine the following dramatic constellation. 25 euro is demanded by Germany on a dividend from abroad, but abroad was already taken 30 euro. Now, naive persons would calculate, I owe you, the German, 25. I already paid 30 to the others, so give me 5 back. You will probably have no success with that. No state pays out money which others got, so the credit claim is limited to the inland tax. 25 is your highest credit because it does not go below 0. In that case, the tax official would just say, you owe me 25, you already paid 30 abroad, okay, that's okay, forget about that, that's a 0 case. I reduce that 25 by the German 25 to 0, not by more, because we don't end up with negative figures here. By the way, that is meant when people talk about the credit limit under the credit method. That's nothing else that you cannot credit more than the inland, your residence, your home state country's tax. They only reduce it to 0, but not to more. So your own home state tax, in that case 25, is the highest limit which you can credit. 10 can be credited, 12 can be credited, 15 can be credited, 25 can be credited, but not 30. Then it's cut off to 25. Your home state tax is the credit limit. Nice terminology for a very, very simple situation. Good. Yeah, we can also think about some cases to practice, ladies and gentlemen. Mr. A lives in Kleve and gets a dividend of 500,000 euro from company in the Emirate of Farawaystan. And there is a DTT with Farawaystan which complies exactly with the OECD Model Convention, and Germany applies the credit method for the dividend under the Article 23. And there one would have and should have to think about the potential solutions, and that is something which we have to do now. So let us have a look. The first thing which we have to solve here is the personal status. So the DTT residence country has to be determined. And Mr. A is a natural person. So it's an ESTG case. So unlimited tax liability in Germany under 1.1 ESTG. That means we have now to look to that Article 4 and 4.1 of the OECD Model Convention in order to find out where our friend is resident. So let us have a look to that OECD Model Convention, scope of the convention, preamble. That's not our stuff. Article 1, 2, 3, general definitions. 4, resident. Yeah. 4.1, for the purposes of this convention, you remember that only when it comes to reading that convention, we agree on what resident means, nothing else. For the purposes of this convention, the term resident of a contracting state means any person who, under the laws of that state, is liable to tax therein by reason of his domicile, residence, place of management, or any other criterion of similar nature, blah blah. And this term, however, does not include any person who is liable to tax in that state in respect of only income from sources in that state situated therein. So let us translate. If you are liable to tax in that state by reason of your domicile and residence, you are unlimited taxpayer there. And then second 2 clarifies the thing. Unlimited taxpayer is nevertheless no person who is only a limited tax liability taxpayer. Good. Plain, simple, and easy. So that's everything which we have to think about. Yeah, okay, that's already. So test is Article 4.1, and the result was A is resident in Germany for the DTT. That was already everything here. And now number 2 will be events. We only have one event. The dividend from far away Eastern, 500,000. Now, two questions have always to be posed. That is what we found out. First question, what can the source country do? So what can far away Eastern do? Because that is here the source country. Let us again look into our convention. 4, 5, 6. Here the distribution articles begin. Business profits, no. Shipping, associated enterprises, no. Dividends. Okay, dividends sounds good. So 10.1. Dividends paid by a company which is resident of a contracting state. Okay, stop. Let's directly find out and fill in. Dividends paid by a company, where in our case was the company resident? That was resident in far away Eastern. So a contracting state, or the one contracting state, is evidently far away Eastern. To the resident of another contracting state, paid to a resident of the other contracting state, well, paid to somebody in Germany, because A was resident in Germany, we found that out, might be taxed in that other state. And now what was the other state? The other state was Germany. Yeah. So the result from 10.1 is evidently absolutely clear, easy. Dividend can be taxed in Germany. Let's shortly write that. So that was here the question, naturally, ladies and gentlemen, what can far away Eastern do? And that was, no, now a surprise first. Article 10.1 said Germany can levy a tax on the dividend. That's first a surprise. Here something seems to be missing, because that just says something which is normally self-evident. The state of residence can always tax. So we should check if there's something missing. Let's perhaps read the second paragraph of Article 10 still, and then find out. So look again here. However, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident. Let's translate directly. Such dividends, these dividends can also be taxed in the country where the company is, so can be taxed in far away Eastern. Good. Now, and according to the laws of that state, so under far away Easterni national law. That's self-evident. Nobody needs to say that, but they say it just to be nice to us. But if the beneficial owner, that's nice for recipient, not exactly a technical term, but yeah. So if the person who gets the dividends, to say it plain and simple, is a resident of the other contracting state. Now, what was the other contracting state in our example? That was Germany. So let's fill in. But if the person who gets the dividend is a resident of Germany, which is our case, the tax so charged shall not be higher than 5% of the gross amount of the dividends if the beneficial owner is a company, but not a partnership, and holds directly at least 25%. That's not our case, because our beneficial owner is Mr. A natural person and not a company. So we end up with the applicability of 15%. So letter B, far away Eastern can also take a tax, and that tax can be 15% of the gross amount of the dividends. So let's write that down again. Article 10.2, but far a Wayston can take 15% tax to here, that is 15% of 500,000, that is, oh my god, 75,000 euro. I hope at least. Now, question number B. How must the residence state, Germany, react to the fact that Far Western has the right to levy a tax? Now, Germany, is it the A or the B group? Well, when it comes to Germany and taxation, that's always tax class A. And you know, Napoleon has been in Germany, and yeah, so the A variant. So let's already note down Article 23A, and then let's look again into 23A. So let's turn some pages. You know, the turning of pages keeps you fit. Turn 1,000 pages, that saves you a visit to the gym. Or the fitness studio. Here, 23A, exemption method. So, where a resident of a contracting state derives income, and now you can forget the next words which refer to the wealth tax, which does not exist in Germany at the moment, where which, in accordance with these provisions of this convention, may be taxed in the other state. So I translate, where a German gets income which, according to this treaty, can be taxed in far away stand than the first mentioned state, that was Germany, then Germany shall exempt this income from tax. Now, surprise, anger, catastrophe, because subject to the provisions of paragraph 2 and 3. That means if the provisions in paragraph 2 and 3 do not say something else, so let's, for the sake of being certain, read paragraphs 2 and 3. Where a resident of Germany derives items of income, gets dividend income, which, in accordance with the provisions in Articles 10 and 11. Yes, and we had that. We had Article 10. So where a German resident gets income under Article 10, which may be taxed in the other state, so in far away stand, then the first mentioned state, that is again Germany, shall allow a deduction from the tax. That's the so-called credit method. Shall allow as a deduction from the tax an amount equal to the tax paid in far away stand. Such a deduction shall not, however, exceed that part of the tax, blah blah, the German tax. Plain and simple again. So 20A, paragraph 2 is evidently applicable, not paragraph 1. Here, the exemptions referred to here, one of them applies indeed. So 23A, paragraph 2, Germany has to credit, not to so let's make that nice. Article 23A variant, paragraph 2, Germany must credit the 15% tax from far away stand to its own tax. Now, anything else in the case? And the answer is no. Case solved. Isn't that nice? Okay, so you know how a simple case might work, and naturally we're not going to leave you alone with that, but just try to find out if we can do that with another tax case again. So this case is the next case we can have a look on. seems to be a bit more lengthy, but let's look if with our principles we can approach that case also and have a chance to survive. Mr. B lives in Germany, and there is a D missing in the slide. You know, nobody's perfect, and I try to be an example for that rule. Okay, and also has a home in Norway. Good. Why Norway? Answer, why not? He has a job in Kleve, Germany. His family lives also in Germany. All his private relations, golf club, chess club, divorced wife, present wife, future wife, is in Germany. And now Mr. B has income from following sources. Income from a house in Norway, which is let to tenants, 10,000 euro. Income from a house in Kleve led to students, 5,000 euro. A dividend of 200,000 on shares which he holds as private property. And now we should add where that shares are from. And let's say they come from Norway. And fees for his consulting services, where he did consulting services for Norwegian customers, 300,000 euro. So that's the point. That's what we have to deal with, and let's have a look. Let us start again with the DTT residence. And for this, we need to know where our taxpayer is resident. We can begin with Article 4.1 of the DTT, and that says you are resident where you are subject to unlimited taxation. No, unlimited tax liability, sorry. 1.1 ESTG, because residence home is at Kleve, Germany. But there is also unlimited tax liability, at least to presume, in Norway, because he also has a home there. So that means no clear decision on residence under Article 4.1, and that means we will have to go on now. Sorry. The test is now Article 4.2 of the OECD Model Convention, because if that first article brought no solution, we had now to look there, and that is what we have to do now. And so we have a look into that convention. Here it is again. For one, we have already done this. Now, where by reason of paragraph 1 an individual is, and now you can think of still a resident of both contracting states, that's our case, then his status shall be determined as follows. First attempt is deemed to be a resident only of that state in which he has a permanent home available to him. Now, Mr. B, in our case, had a permanent home in Germany and a permanent home in Norway. So that does apply here, and permanent home in Germany and in Norway. This is again no clear decision. So let's look for the next criterion. The next criterion here we find again still in letter A, second half of the sentence. If he has a permanent home available to him in both states, he is regarded to be a resident only of that state to which he has his personal and economic relations in a closer way. That's called the center of vital interest, and it means that the personal and economic relations must both be closer to that state, and that is now what we have to find out and to check by another look at our case data. So let's read the case again. Family lives at Germany. All profit relations are at Germany. So when it comes to center of vital interests, then we have to look to first private relations, mainly to Germany, and economic relations, mainly Germany. The job, having also one house in Germany, that does not, job in Germany seems to be clear. The Norwegian customers are served probably from Germany here. And well, the dividends, don't know if that established such a strong economic relations here. Seems to be clear that center of vital interest is in Germany. So Mr. B is resident of Germany for the DTT purposes. Good. Now we got this, and after part 1, part 2 naturally must begin analyzing the events. Now we have something to do. 2.1, income from a house in Norway. First question was again, what can Norway do? And then we have to test again the double taxation treaty. And beginning from the Article 6 to 21, we have to look them all through if something shows up which might be of interest for us. So yeah, let's try this. Here is it. We had that already in another context mentioned today. Income from immovable property. Yes, naturally, a house is immovable property. That's clear. Clearer it can't be. Income derived by a resident of a contracting state. Now we fill in income derived by a German from immovable property in the other contracting state. So in Norway, other contracting state is thus Norway. Can be taxed in that other state. So can be taxed in Norway. So simple, plain answer to our question here was 6.1. Norway can levy a tax. Now, the next question will naturally be, how will Germany have to react? And we are first going to write down our result from this little check here and then look into Article 23. So let's write it down. Norway may levy a tax, Article 6.1 DTT. And now second question is, how must Germany react? And we remember this was a question for the Article 23 and Article 23A. Now we only have to find out if it's one, the exemption method, or if it's that one of the rare cases where also exemption states have to apply the credit method. Well, let's look. So, basic rule 23A, first paragraph, where a resident of Germany gets income, blah blah, which may be taxed in the other state, so in Norway, where a German gets income which can be taxed in Norway, the first mentioned state, that was Germany, shall exempt such income from tax. Exception, paragraph 2. If it is treated in Articles 10 and 11, then credit method. We did not have Articles 10 and 11, we had Article 6. The next exception or clause might be paragraph 3, and in paragraph 3 we see where, in accordance with any provision of the Convention, income derived from a resident of Germany is exempt from tax. Then in calculation the income, blah blah, the proviso safeguarding progression may be applied nevertheless. So that's just a clarification of things which are self-evident, because Germany can determine the rate as it wishes. So the material important paragraphs are only 1 and 2. 2 does not apply, so we end up with our paragraph 1 here. Exemption. Germany has to exempt. That is our next result, and we can write that down again. So that was Article 23a. Germany exempts this rent income. Next event, 2.2. House at Kleve let to tenants. Okay, then what can Norway do? Let's have a look. That sounds again as if it might be Article 6, so the immovable property. So we should have a look there too first. So let's try to read Article 6. Income derived by a resident of contracting state. So income which is received by a German from immovable property situated in the other state, and now the other state should be Norway, but this is a house at Kleve, so that doesn't fit. So the Article 6 is not our constellation, it's not our case. That's a bit bad, because in international treaties there is a kind of a rule what is not explicitly regulated is not regulated at all. So a promise which is not explicitly made to treat a case in a certain way does not really exist. So Article 6 does not cover our case. So if we don't find another article, our case would be uncovered. So double taxation would occur probably. And fortunately, we can do what experts always do: turn pages. Page, 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 interest, royalties, directors' fees, sportsmen, pensions, government service, students, but other income. There is a catch all the rest clause here in Article 21. Items of income of a residence of contracting state. So income of a German, wherever arising, so wherever it comes from, be it from Norway, be it from third states, or be it from Germany, which is not dealt with in the foregoing articles of this convention, shall be taxable only in that state, so Germany. So 21, paragraph 1 solves our problem. Income which is not mentioned before is only taxed in the residence country. That was Germany in our case. So we can put down in our little notes that the rent from Kleve can only be taxed in Kleve. So, sorry, cursor must be placed correctly, otherwise program doesn't work. So Article 6.1 does not cover this case. So we end up with Article 21.1. Only Germany can tax this income. B. Obligations for Germany to avoid double taxation, none. Article 23a does not apply because that is only reserved for cases when the other state, the source state, may levy a tax, but it may not. 2.3. Next event, dividend from Norway. Well, and I still must admit I didn't place that it is from Norway on the slides. That was a mistake, or a negligence, which might deserve capital punishment, but we agreed on it's from Norway. Do you remember there was that strange Article 10.1 which said Germany may tax it? But then there was 10.2 which said but Norway can also levy the tax of, and now that was either 5% or 15%, and the 5% were only for parent company with 25% participation at least. So Norway, when you have a natural person as a shareholder, can levy a tax of 15%. That was, by the way, 10.2 letter B. If we can be more exact in the citation, we should be. And let's look up again, how is double taxation now avoided by Germany? That would be a good question. Where a resident of Germany gets income which can, in accordance with the provisions of Article 10 and 11, may be taxed in Norway, then blah blah credit method applies. Germany allows as a deduction from the German tax an amount which is equal to the tax paid in Norway. So the credit method applies here. So Germany applies the credit method. That was Article 23a, paragraph 2. Now we come to 2.4. Fees from Norwegian customers. What can Norway do? The source state. We have to look for a rule on business income. And naturally, we can expect there will be one in the double taxation treaty. So let's again have a look. And indeed, here it is. Article 7, business profits. Profits of an enterprise of a contracting state. Now, this enterprise is always belonging to that state where the owner is resident. So this is a German enterprise. Profits of a German enterprise shall only be taxed in that state, so in Germany, unless the enterprise carries on business in the other state, so in Norway, through a permanent establishment is situated therein. Now, a permanent establishment is, as you already know, basically a shop, offices, premises, something, where you established your business on a permanent basis in the other country, where you have rooms or devices, machines serving the purposes of an enterprise on a permanent basis. That is not the case in our case, because you only gave consulting advice to customers in Norway. Nothing is mentioned about offices there or similar things which belong to the enterprise of our Mr. B. So, result, only Germany can tax the profit of the German enterprise because there is no permanent establishment in Norway. Okay. Let us write the result of our examination down. Article 7.1, Norway may not tax, only Germany can tax. these profits, and that leads to which obligation of Germany? And the answer is none, because Article 23a does not apply. Sorry, does not apply. Writing is difficult because no double taxation is possible. Norway is already out of the game, and Article 23 only applies if the source state can levy a tax. Only then the state of residence has any obligation. This is not the case. So now we have arrived at the last event in this case. So let's show some triumph. Case solved. Naturally, ladies and gentlemen, you never do such childish games in an exam. That's just to be, to show that I'm happy that I'm through with that case. You see, this was now far longer than the first case, but nevertheless, it was always the same principles. It's just playing a bit of ping pong between the Article 6 to 21 and then Article 23. Always the same structure, always the same procedure. At last, allow me some last remarks. What would happen, or how would you deal with a case when you had to think about both levels? So the double taxation treaty rules on who can tax which income, and how that is then done on the national level. Well, then it would be recommendable probably to arrange the testing steps in the following sequence. That you begin with the personal status, and now if you want to have some rationalization effects, you keep in mind, or you remember, that Article 4 required that you were unlimited tax liability taxpayer in a state. So it might be a good idea to test that first, because that's an information which you already need to have when you apply Article 4. So here I would begin with personal tax liability and then shift to double taxation treaty residence country. When it comes to the events, the sequence of national law and DTT law is exactly the other way around, because before you apply national law, you must find out which national law. So there you would go into the rules of DTT law first, and then apply national law according to the adequate testing scheme, which is, a different one for unlimited tax liability or for limited tax liability events. Good. Just to show you that again here as a graphic, you have under the personal status the national law first, then the DTT rules, then the order reverses when it comes to analysis of events, the DTT rules first, and then the national law. So you have a kind of a B, A structure, A, B, B, A. And so if you want to memorize that testing scheme, if you keep ABBA as the structure in mind, everything's well. If you don't keep ABBA in mind, then you might experience your personal Waterloo. If you don't understand why ABBA has to do something with Waterloo, then ask your parents or grandparents. I can't do anything about it. Okay. That was now a relatively long lecture. Probably some of you have died in the meantime. I hope not. I hope you survived it well. I hope you can perhaps even remember the one or other aspect. It was for me a great pleasure to play around with the programs here and to make the video, to talk your ears off and so. And as always, you can press a like button. You can make somebody familiar with that video whom you like or not like. And I hope it might also be a little help for practicing for exams when you see how cases are written. And naturally, it might be that you will, even as beginners, be asked a bit about such things. Yeah, hope you enjoyed your day, whichever day it was today. Hope you didn't watch that video just half an hour before your exams, would be awkward. Um, and I look forward to seeing you again, either in the rather impersonal way on this channel or in real life, whenever that will be. Thanks very much and wish you the best. Ciao.